Good morning and welcome to TOITOI Japan Market Radio. I'm your host coming to you from Tokyo on March 17, 2026. This is our daily briefing for global investors tracking Japanese equities, currencies, and rates. Let's dive straight into what moved markets overnight and what you need to watch today.
Thanks for having me. Looking at the overall picture this morning, we're seeing a fairly challenging session for Japanese risk assets. Unfortunately, we don't have complete index data available at the moment for the Nikkei 225, TOPIX, Mothers Index, or J-Right benchmarks, so we're working with a bit of a fog on the headline numbers. Similarly, USD, JPY, gold in yen terms, and crude oil pricing aren't fully populated in our dataset. But what we do know from the news flow is that sentiment has taken a hit, and energy concerns are front and center.
Right, and that energy theme is really dominating the narrative today. Let's start with the main headline that's been circulating since last night. Japanese stocks slipped as oil price concerns weighed heavily on sentiment. This isn't just a one-off wobble, it reflects a broader unease about energy costs and what that means for the macro backdrop in Japan. Can you walk us through why this matters so much for Japanese markets specifically?
Absolutely. Japan is one of the most energy import-dependent developed economies in the world. Oil is a critical input not just for transportation but for manufacturing, chemicals, and utilities. When oil prices rise, you see immediate pressure on corporate profit margins, especially for exporters who are already navigating tight cost structures. Transport operators and energy-intensive manufacturers feel it first. Beyond that, higher oil prices worsen Japan's trade balance because import costs spike, and that feeds into inflation expectations, which complicates the Bank of Japan's policy calculus. Finally, it hits consumer purchasing power, which dampens domestic demand.
So it's a multi-layered impact. Let's break it down by asset class. Starting with equities, what's your view on how the Nikkei and TOPIX are likely to behave in this environment?
We're seeing downward pressure on both benchmarks. The immediate sentiment shift is clear: investors are reassessing risk, and energy-intensive sectors like automotive, chemicals, and utilities are under near-term strain. Exporters are also sensitive to margin compression when input costs rise faster than they can pass through to customers. Now, there's a potential offset if the yen weakens significantly, which can help exporters on the translation side. But right now the dominant narrative is cost pressure rather than currency relief.
And what about the yen itself? Are we seeing risk-off flows pushing it higher, or is the energy import bill weighing it down?
It's a tug of war. Typically, in a risk-off environment, the yen strengthens as a safe haven currency, and we're seeing some of that. But structurally, higher energy import costs are yen negative because they widen the trade deficit and reduce net demand for the currency. If oil prices stay elevated for an extended period, that structural pressure could dominate. On top of that, if the BOJ feels compelled to stay dovish to support growth in the face of rising input costs, that also weighs on the yen longer term.
So the BOJ's positioning becomes critical here. What's your read on Japanese government bond yields in this context?
JGB yields are likely to face downward bias in the near term. Flight to safety flows tend to push money into government bonds, especially in a risk-off environment. But there's a countervailing force: if energy-driven inflation expectations rise, that could push longer-dated yields higher. The BOJ's yield curve control framework will be tested here. If the market starts to believe that stagflation risks are building, higher costs but weaker growth, then the BOJ's narrative around normalization becomes much more complicated. We need to watch BOJ communications very closely in the coming weeks.
Staying with the energy theme, there's a second major development that's adding fuel to the fire, so to speak. A UAE gas field has been struck, and a key oil hub has halted operations as attacks on energy infrastructure in the region intensify. This is escalating quickly. What does this mean for Japan's energy security?
This is a serious concern. Japan relies heavily on Middle Eastern energy supplies, particularly liquefied natural gas and crude oil from the Gulf region. The UAE is a significant supplier, so any disruption to production or shipping routes directly threatens Japan's energy security. If this escalates into a sustained halt, Japan would need to draw on strategic reserves or source alternative supplies, likely at premium prices. That would raise input costs across the entire economy: utilities, petrochemicals, heavy industry, basically any sector with high energy intensity.
And the market implications are pretty immediate, I imagine. How do you expect Japanese equities to react if this situation persists?
Near term, I'd expect negative pressure on the Nikkei and TOPIX. Energy-intensive sectors would face margin compression almost immediately. However, there's a partial offset. If the yen weakens on the back of higher energy import costs, exporters could benefit from better translation dynamics. The net effect really depends on the severity and duration of the supply disruption. If it's resolved quickly, markets may shrug it off. But if we're looking at weeks or months of reduced supply, that's a different story.
And the yen, does this shift the outlook there?
It complicates things. On one hand, risk-off sentiment supports the yen as a safe haven, which we might see in the very short term. On the other hand, a sustained spike in energy import bills would widen Japan's trade deficit and structurally weaken the currency. Over the medium term, I think the structural pressure dominates, especially if the BOJ signals reluctance to tighten policy in the face of external shocks.
On the policy side, does this change the calculus for the Bank of Japan?
Potentially, yes. If energy costs stay elevated, inflation expectations rise, but growth remains fragile, the BOJ faces a classic stagflation dilemma. They can't easily normalize policy without risking a deeper economic slowdown, but they also can't ignore rising inflation. That could keep the BOJ on hold longer than markets currently expect, which would weigh on JGB yields in the short term due to dovish expectations, but also create volatility if inflation surprises to the upside.
And there's a third angle to this oil story that we need to cover. Crude prices have resumed their climb and are pressuring financial markets again more broadly. This isn't just a Middle East story anymore, it's a global commodity rally that's rippling through risk assets everywhere. How does that layer into the Japan narrative?
It reinforces all the dynamics we've been talking about. A sustained rally in crude oil, not just a one-day spike, means persistent pressure on Japan's import bill and corporate margins. It also raises the stakes for the BOJ's inflation mandate. If crude stays above certain thresholds, say in the high 70s or low 80s per barrel in dollar terms, that could force the BOJ to recalibrate its inflation and growth forecasts. For Japanese equities, the mixed impact becomes more pronounced. Energy stocks and shipping benefit, but consumer-facing companies and manufacturers face margin pressure. Net-net, given Japan's energy import burden, I'd lean toward a negative impact on the broader indices.
Shifting back to equities for a moment, are there any sectors that might actually benefit from this environment?
Yes, definitely. Energy trading companies, shipping firms, and commodity-related stocks could see upside as prices rise. But those are a relatively small part of the overall index. The much larger weight comes from manufacturers, tech, financials, and consumer discretionary, most of which are negatively exposed to higher input costs. So the headline indices are likely to reflect the net negative impact.
And if we zoom out to the global investor perspective, what's the key takeaway here for someone managing Japan exposure in a global portfolio?
The key takeaway is that Japan is structurally vulnerable to energy price shocks in a way that many other developed markets are not. If you're long Japanese equities, you need to watch oil and Middle East geopolitics very closely right now. The yen's behavior is also critical. If it weakens sharply, that can provide some cushion for exporters, but it also signals structural stress in the trade balance. On the rate side, JGB yields are likely to stay range-bound in the near term, but any sustained inflation surprise could challenge the BOJ's control framework. I'd say the risk-reward for Japanese equities is tilted to the downside until we get more clarity on energy supply and BOJ policy direction.
That's a really helpful summary. Before we wrap up, any final thoughts on what investors should be monitoring over the next few sessions?
I'd keep a close eye on three things. First, oil futures and any developments in the Middle East. This is the primary driver right now. Second, BOJ communications. Any shift in tone around inflation or policy normalization will move markets. And third, earnings guidance from Japanese corporates, particularly in energy-intensive sectors. If we start to see downward revisions, that's a red flag for the broader equity market.